This is Chuck Carvel. I'm the Chuck in the Market's Up Chuck. And, today's post was I'm disgusted with the stock market. I talked about playing golf with a friend of mine who I just recently met maybe 6 months to a year ago, who finally admitted to me that he was totally disgusted with the stock market. And he told me that he had lost so much money. He had started investing in the market, during the late 90s. And this is a 15-year picture of the S&P 500 that I actually showed everybody on February 25th on a blog that I did on February 25th. And I was pointing out that stock prices were significantly above their earnings justified levels, you can see here. And of course, people were real excited here because stock prices were rising and people, were buying stocks with reckless abandon. He invested there and then he lost money here. And then, that hurt him real badly. And then, of course, he kind of got back into the market, or stayed in the market, I believe. And then, of course, he got hit again in 2008. However, once again, this drop in stock prices are really a function of the market being overvalued, and now he's totally disgusted with the stock market. And the point that's really remarkable about this chart is it's at the time when stocks finally have gotten very expensive. Now, I showed you this in February. The market at that time was trading at 11 times earnings. Earnings forecasts were $71 a share for 2008. I do want to show you that, or excuse me, for 2009. I did want to show you that, but my argument back then was, and this is really still, I believe, too short a time frame to do this, but the PE was only 11 times earnings, and that was significantly below its historical average. And I do want to emphasize the historical average was also based on depressed earnings. Earnings were down, and the PE ratio was less than the historical norm that the S&P would traditionally trade at. Now, let's fast forward this picture to last Friday's close, or June 12, 2009. And now what we've seen, a couple of things that I want to focus on. Number one is that the earnings forecast for the S&P 500 actually fell significantly more than was originally on the first chart. So we had even further earnings dropping. But now we've had this little rally in stock price. And I think the point is, earnings have fallen, stock price have risen a little bit, but now the price-earnings ratio on the S&P 500 is now at just under 18, which is above its historical normal value. However, I want to point out that's on further depressed earnings. So it's really not so much what is the true price-earnings ratio of earnings 3 or 4 years out. And if you would assume that the market could begin to get back to its more normal earnings power, then you could still see the S&P 500 being very cheap here. I do want you to notice that the last time we had a recession, which was back here in 2001, we ended up with a minus 30% drop in earnings. You can see the S&P's earnings went from $55.83 to just under $39, $38.94. But then they rallied. They were up 17% the following year. Then they were up 19.5%, then 24%. So coming out of a recession, because of easy comparisons, we did have 3 or 4 really extraordinary years of earnings growth. And of course, you can see the stock price followed that, and kind of even though it was started out somewhat overpriced, it did kind of follow that, and we had a good period here where the S&P went from something around 885, and it got up to 1270 by May. Now, the point of this whole story is, I do believe that we are looking at a situation where we're measuring price-earnings ratios, although now slightly above its historical norm. We are measuring that where earnings are very, very depressed. And I do believe, as I've talked about in other segments of the blog, we're going to see, there's a lot of discussion right now about the economy getting better and the signs of a recovery. I think those things are all true. I never try to predict that perfectly. My whole point is, if you remember the Warren Buffett article back in October of last year in the New York Times, his whole point was that, in the long run, these companies' earnings were going to be strong again. I think businesses have, really reconciled their P&L statements. They've cut costs. They've downsized their businesses. They've got their inventories under control. So once things begin to normalize a little bit, we really should see an acceleration of earnings growth. And then I think you would see that stock price would be very, very cheap. But the bottom line is stocks are still cheap based on historical basis, and buy low, sell high will never go out of style. This is not the time to be running from the market. This is the time, in my opinion, to be embracing the market. I hope this made some sense, and I look forward to talking about some real opportunities that I believe this market has created, because as I always point out, I'm a believer in a market of stocks, not a stock market, and this is the average. There's a lot of bad companies in here as well as good companies. I like to focus on the good companies, and I'll be looking at some of those later on in the week. Stay tuned for that, and this is Chuck Carvel saying thanks for listening.